Joining us from Ahmedabad is the Chairman and Managing Director of the group and the company, Sanjay Lalbhai. Good morning, Mr. Lalbhai. Thank you very much for joining us. From where you sit, what's the economy looking like right now? We've had the first 3 months of the first quarter of this financial year, complete. How's demand looking?
Things are coming back slowly. There are green shoots in many industries, as you know. Automobile sector is doing very well, cement, steel, FMCG, banking. So there are many banking NBFCs. So there are many green shoots and many industries are doing pretty well. As far as textiles brands are concerned, I think the demand is reasonable. I can't say that it's come back to normal, but it's a reasonable demand. But we are expecting a normal Diwali this time.
Okay, how far away from normal is it? What's the gap even now?
I think 5 to 10%, depending on month to month. Some months are 100% or even above 100%. Some months go below. So one thing is definitely happening. The discretionary income is getting split between various categories. As you must be knowing that there are now many opportunities for people. People are traveling more. People are eating out. People are spending money on entertainment. A lot of money is going into telecommunication. So I think the share of the wallet is definitely getting split. We need more people to come into the higher middle class so that the spending power can increase.
Okay. You had offered some guidance at the beginning of the year for the financial year 2018-2019, and that guidance suggested that the company was looking forward to about 10% growth in the textiles business, whereas margins would be flat, about 20 to 24% growth in the brands and retail segment, where margins were likely to expand by about 100 basis points. The engineering business would grow at about 10 to 12% top line, and that margins would be stable there. Based on the experience of the first 3 months, do you feel that you're on course to be able to achieve these guidance points?
Very much so, very much so. We are on course, and we are not anxious about the kind of guidance what we have provided. The only issue could be the trade war, but we don't believe that the trade war is likely to happen. In any case, even if the trade war was to happen between America and China, in many cases, India would be a winner.
Could you talk us through why you believe that, you can only stand to gain? And if there's any way to specify, what the amount or nature of those gains would be, because we've seen metals right at the center of the trade action taking place reciprocally now between US, China, Canada, EU. Textiles also is in the fray. What do you make of how India will be impacted by any of this, and what your group or company can stand to gain as a result of this in the next 6 months to a year?
Menka, the entire value chain of textiles, let's start with yarn, fabrics, garments, and then branded, apparel. So if the war was to continue, then there is a very high import duty which has been imposed by America on Chinese goods. And China currently has 35% market share of the world trade. So it's one of the largest market shares which China is enjoying in this segment. Now, this would mean that every other producing country, could be India, could be Bangladesh, could be Sri Lanka, could be Vietnam, could be Turkey, could be the North American countries, whoever is supplying textiles or any of the components of the entire value chain would tend to gain, because it's impossible to replace 35% of 850 billion business. The size of the global textile business trade is 850 billion, of which China has 30-35% market share.
And you expect these gains to accrue in as quickly a period as 6 months to a year, or do you think this could take even longer? And materially, what would it mean? Like, can you see, or will you see, or are you already seeing enhanced buyer interest internationally for either textiles or for apparel, white label apparel maybe even?
There are two things. One is that as far as Arvind is concerned, Arvind has strategic buyers and we have a reasonably good visibility with them because we are strategic. And if the China was to impose these kind of tariffs, I'm sure that they would try and procure as much more as they could from us. Now our issue is that we are pretty much working at full capacities. So we'll have to figure out as to whether we can outsource or whether we can work with number of distressed assets and use them to help out our suppliers. But it is a very difficult kind of thing to figure out what the quantity could be. The benefit could accrue right away because if the tariffs were to be imposed, they are quite steep and they are 25%. So I think all our buyers in America would try and buy more from their existing customers globally, suppliers globally.
Okay, but do you have already like buyers expressing interest, sir? Saying, can you enhance our order by 10%, 15%, 20%? That's one side of it. The other side of it is, where will all that China supply go? So could it potentially roil for you any other markets that you might be servicing? Could it have any kind of, substantial price impact? Though I know that it's not one linear global market that functions, but nonetheless, because that supply from China has to go somewhere.
That is true, but China would find it very difficult to kind of service any of the other markets. And if you really look at it, we are servicing, our biggest market is America, followed by Europe. Now, yes, one of the questions could be, can they supply things to the European market? And they would. As far as Arvind is concerned, because we are strategic and we have developed products, it is not that simple to develop the similar products in a very short period of time. But given 6 months, yes, people can come and the best mills could try and compete with you in certain markets like Europe. But I think suppose there is pricing pressure in European market, I think it would be broadly and more than even compensated by the American market, if that was to happen.
So you've guided for about 10% growth in the textiles business for FY19. If these benefits were to accrue in this very financial year, do you think that growth on account of higher volume or higher sales because of the China situation could go up to 12 or even 14, 15%? Would that be a fair assessment?
As you would know that it's so difficult to figure out as to finally what will happen, and I personally believe that it is a very unlikely event because both the economies and mostly China is likely to lose out dramatically in this war. So my reading is that finally a logical solution will evolve. But suppose that was not to happen. As I'm saying that I'm already functioning at 100% of my capacity. So stating that I'll be able to take a very large advantage of this situation could be also misleading.
Okay, fair enough. A quick, so I'll leave the trade bit aside. You've dwelt quite a bit on it. A quick update, if any, required with your plan to separate out demerge your businesses into, the textile, the brands and retail, and the engineering bit. The last estimate I read was about 3 to 4 months. Is that on course?
It's absolutely on course, and this is to unlock the kind of, I think all these companies have acquired a situation where they are financially independent, they are financially pretty strong, and they have very strong managements, and they are capable of now charting their own path. And as a result, it is most natural that we would try and assign these companies to the existing shareholders. So I think the listing is on schedule, and this would be very good because really the kind of potential of each business will get enhanced. This gives us enough elbow room to raise capital independently. The management teams will be very focused rather than getting clubbed in a conglomerate. So they have a very clear kind of financial numbers to show to the investors. And as far as investors are also concerned, they would like to select as to which is the kind of business they like, and they will be able to, in a very focused manner, invest in businesses which are of interest to them. So yes, this should unlock value, this should unlock a lot of shareholder value, and that is what we are trying to do. Our whole objective is to create shareholders' value.
Fair enough, sir. I have one last question, sir, for you. I know that you'll give us a lot more number details when your earnings are out. But before that, there have been various different growth areas that your company has identified. We've been speaking to Kulin as well on this. The bit on verticalization, the bit on white label apparel, your investment in expanding your textile capacities. So over the course of this fiscal, which levers of growth do you think are going to kick in the hardest, the fastest, and therefore what the financial impact of those will be?
See, one of the things which has happened over the last 5 years is that most of the free cash flows, and we are not leveraging our balance sheet. So we are only growing out of our free cash flows. We are not increasing any debt. So that was getting assigned to these various businesses. Now that these businesses have become financially independent, like brands, engineering, and even 2 years back, we had segregated our real estate business. So that is also growing very, very well, and that publicly listed company, Arvind Smart Spaces, is doing pretty well. So this year, the focus would be to use all our free cash flows in growing our textile business, because we are very, very buoyant about it. And there are 4 strategies as far as the textiles is concerned. Our total investment is going to be 1,500 crores in 3 years in the area of textiles. We are becoming vertical. So instead of selling fabrics to Bangladesh converting it into garments and giving it to Gap, we will be directly from fiber all the way to garment, giving a complete one-stop solution to most of our customers. We have only 10 customers globally, so our relationship will become deeper. It is not only giving a final solution, but we will add innovation and design to what we are offering to our customers. And as a result, we will become much more strategic to them. So this is one large area of verticalization is our focus. The second area is we are building brand Arvind. So Arvind B2C, fabrics and ready to wear. We are doing everything. We are opening EBOs, MBOs, and we are also selling through the large format retail outlets. So this business is likely to grow very much, and the brand Arvind will grow over the years and create a different kind of valuation and a different kind of growth trajectory. So that is number 2. The third area of great interest to us is that we are entering a very interesting area for the first time in India. That is the sportswear and athleisure. That is the fastest growing category world over. Adidas, Reebok, all these people are growing dramatically. And their apparel category, not only footwear, but the apparel category is growing very fast. People are not using sportswear only in the gyms, but the athleisure is now going out of gyms as casual wear. So this is a very exciting thing. This is 100% man-made. This is very high on technology, and this is one of our focus growth areas. And the fourth and the most exciting is the technical textiles, or we call it advanced material division, where we are growing using the knowledge of our textiles. We are growing in composites. We are growing in technical textiles, making fabrics like belting fabrics and filtration fabrics. We are growing in making upholstery for cars. So these are all the technical uses of textiles. And this is very high on intellectual property rights. This also requires very good understanding with foreign players who have either patented technologies or who are the leaders. So Arvind is signing up number of such players globally, and this is one of the fastest growing businesses in our textile portfolio.
So I just, Mr. Lalbhai, forgive me for interrupting you, but these are things that your company and you Kulin has also been talking about in the past. This is all factored into your guidance, right? So there's no additional boost to growth or revenue or profitability that will come about on account of these things, because these are things you all have articulated in the past as well, correct?
That is true, but I think if you see that in the last 5 years, our growth in textiles was reasonably muted. Now, with 1,500 crores investment, I think we will be upwards of 10% growth, and that too on a base of 7,000 crores. So we intend to grow by more than 1,000 crores to 1,500 crores every year. And if we can maintain that kind of growth and execution, then definitely it will reflect also in our numbers.
All right, Mr. Lalbhai, deeply appreciate you joining us this morning. Thank you very much, sir. I know we'll have more time when to discuss your numbers in detail when your earnings are out shortly. Thanks very much for that.